Hey, if you've got an internet connection, I'm sure you've seen the wealth cheat code, right? The gurus call it buy, borrow, and die. They tell you to accumulate assets, borrow against them tax-free to buy your cars, your vacations, your Rolex watches. And so then when you die, your kids get a step up in basis on these assets, which wipes out the debt and all the taxes. Well, listen, I'm here to tell you that is complete BS. Listen, 99% of the people out there, this is not a wealth strategy. Basically, it's a financial suicide mission because when you do the math, it doesn't work out. I mean, that whole strategy, maybe when you're in a 1% interest rate environment, it possibly works. But now we're in a 7% interest rate environment, and it's just not going to happen. That's why in this video, what I'm going to do is I'm going to do a deep dive into this strategy and show you why what they've been talking about, borrowing against your stocks or your crypto or your personal residence, all right, to fund your lifestyle, that is not where your ATM is. And that's going to lead to financial ruin. All right, let's get started. Okay, think about what's happening here. Let's assume that I have a house, right? And this house is valued at $5 million. So it's a $5 million home. I know it seems a lot, but just understand, even if you don't have a $5 million home, just follow the math. Now, during your lifetime, you follow this strategy and you borrow against this property. Let's say we take out $3 million. Now, assume that you bought the house for $1 million. Okay, so when you die, what happens, right, to this scenario here? Well, when you die, yeah, you get a full step up in basis from your asset value, what you purchased it for, $1 million, to its current fair market value. But the thing you need to realize is that even though you're not paying any estate tax on this or income tax or capital gains tax when you sell, what you do is you're going to have to pay off this debt of $3 million that you've taken out against it. And that assumes, when I say $3 million, let's assume it's been grown at 6% interest. So actually you only got about possibly $2 million, but all the interest is added up. So the loan is now worth $3 million. So effectively what happens is that you have $5 million value of the house, you take away the debt, and so what does that leave your kids with? It leaves them with $2 million. All right, so you didn't borrow this wealth appreciation strategy. It didn't work out for you. You lost $3 million by following this advice. You see, wealth isn't built this way, and that's the problem these people don't understand. What they're trying to do is build a lifestyle around their current assets, so essentially they die broke is what could happen. What you need to do in this scenario is if you want to die wealthy, you want to leave your kids something, when you borrow money out, you don't take it and use it to spend money on something that is going to depreciate, like a Tesla, like a Rolex watch. Well, maybe some of those will go up in value. But the point is you take it and you reinvest. So every investor out there knows this. If I had a house and I'm going to borrow $2 million out of this property, then what I want to do is not buy the cars. I want to go out there and maybe buy 3 houses with that $2 million. Now I have that money into 3 other assets that are appreciating in value. Now, when I pass away, all of these properties are going to be stepped up to their full fair market value. So this property is now at $5 million in my previous example. So that's going to pass to my kids tax-free. Let's say each of these homes appreciated to $2 million in value. So that's going to be another $6 million that passes to my children tax-free. You see, this is the reality of the situation that you want to be looking at here, is that you don't want to borrow the money for consumption, you want to borrow the money for reinvestment. Now, these homes that I turned around and I reinvested, rather than just spending my equity and reducing the value, by putting it into an income-producing asset, what you're doing now is you're creating that income stream that you need to buy your Teslas, to buy your watches, to take the vacations that you're looking for. It's coming from these assets, but you're also getting growth from that. You see, the concern that I have when I watch these gurus and they tell you to do this is some of them will say, hey, you have assets, you have your personal residence, my home in which you live, you have a stock account. Okay, that's another asset. And they'll say, here's what you want to do. You want to take a HELOC on this property. On your stock account, you want to use the margin borrowing power on that in order to fund your lifestyle. Now that is great as long as the market's going up Okay, with your brokerage account, margin, well, you can cover it. But same with your personal residence. As long as the real estate market remains strong, right, and the debt doesn't exceed the property value, everything's awesome. But if we hit a downturn, what can happen? All right, so look at it this way. If you have stock account and it has $500,000 in there, and you borrowed out on margin $250,000, okay? So the way the broker looks at this, even though your account's still valued at $500,000, you've provided this as collateral for your loan. So if the market tanks and you lose 50% of that value, what they will do is call this due, wipe out your account, and the broker is going to pay himself off, and you have zero money left over. I've seen this happen before. I've been through 2 stock market crashes, and I've seen this hit people hard who were using margin and were not prepared for this. This is reality here. And the people that are telling you to borrow on margin against your brokerage account and turn around and use that to fund your lifestyle, they're not living in reality when they tell you that, because of what could happen in this scenario. Now, if you are already planning to use it, then it possibly makes sense. If you're thinking, hey, I plan to sell this anyways and fund my lifestyle, that's all right. But what really freaks me out is with the personal residence, right? When you go out and you pay in a HELOC to fund your lifestyle, because what you're doing there, again, is you're putting your personal residence in jeopardy. If the market crashes, right, you have a loan there. What I've seen banks do before is they will accelerate that note, call the note due, and then all of a sudden you've lost your home. Now, here's one of the strategies that they tell you, okay? If you listen to enough of them, they tell you, don't worry about this, it's easily fixed. And the fix everyone likes to talk about here is to buy this, right? Insurance. All right, as long as you're buying insurance, so let's go back to my basic example that I talked about before. So here's your house, and I said it was at 5 mil, and let's say you borrow out 2 million. But by the time you die, all right, because of the interest on this, you've now accumulated, you have $3 million there, all right, in debt. So the 5 million offsets the 3 million, which leaves your kids $2 million left over. But you're going to make that up, they say, because you're going to take some of this money you took out and you're going to use it to fund a life insurance policy. You see, life insurance, as they accurately state, it's income tax free. And you can have it avoid estate taxes if that was a concern for you by setting it up in an irrevocable trust. Now, what they don't tell you is that to have this policy when you're 83 years old, what does that cost you in terms of insurance to insure yourself at 83 years of age? Because remember, this policy has to last longer than your life in order for your kids to get paid. I mean, literally, you could have insurance premiums on an annual basis of maybe $75,000 to $100,000 a year. Well, how much more then are you going to be taking out of your property in order to fund this policy? And if you don't fund it, then the policy will lapse. And so what happens is you just get caught in this circular rabbit or hamster wheel here where you're borrowing money to pay insurance to make sure your kids get the money when you pass away. It becomes a little nightmare for people when you're thinking about this strategy. I mean, it sounds great on paper, just the headline alone. But the reality is, at the end of the day, when you pass away, you're going to leave your children a ton of debt, and you've depreciated your assets as a result of this because you wanted to live a lifestyle today. That is not how the wealthy make their money. What the wealthy do when it comes to making their money is they take the money out and they reinvest it. It's called leverage. You use your assets to go out there and buy other assets that are appreciating or producing income. As you start to eat away at your savings account or your brokerage account or your personal residence, all you're ensuring is that at the end of the day, that will not be there for your beneficiaries. So if you're thinking about buying assets, borrowing against them to fund a lifestyle, and then die and get a full step up in basis, hey, it's not going to work. I hope you understand this. Don't let those 30-second TikTok videos or videos you see on Instagram or YouTube shorts of proclaimed gurus convince you to gamble your children's future on the hope that the interest rates will stay low and that you're going to live forever. Because in that game, the only people who are consistently winning, I'm telling you this, are the lenders. There's no wealth cheat code here, right? This is a debt trap in disguise. If you're actually looking for a strategy that does not involve possibly bankrupting yourself or your heirs, then follow the strategies of the wealthy people. Borrow that money and reinvest. Hey guys, if you like this video, hit the like button. And if you heard other people that have been following this or talking to you about this potential strategy of, buying the money, the wealth cheat code, do this. Send them to this video and let them get a wake-up call on what that could actually mean for you. All right, everyone, I wish you the very best with your investing.